Question 1. Which of the following is the primary purpose of an insurance contract? An insuring agreement. A. To specify the exclusions of the policy. B. To outline the duties of the policyholder. C. To describe the risks that are covered by the policy. D. To define the conditions for policy cancellation. Answer. C. To describe the risks that are covered by the policy. Explanation. The insuring agreement is a crucial part of an insurance contract as it outlines the insurer's promises regarding what risks will be covered. It identifies the perils or risks that are insured under the policy and the conditions under which coverage will apply. This provision is central to the policy because it sets the scope of the coverage provided, which is a key element of the agreement between the insurer and the policyholder. Option A refers to the exclusions, which are separate from the insuring agreement and specify what is not covered. Option B addresses the duties of the policyholder, which are typically listed under conditions, not the insuring agreement. Option D is more aligned with the cancellation provision, which also a separate part of the contract addressing when and how the insurer or the insured can terminate the policy. Question 2. Mr. David, an insurance agent, is selling a health insurance policy to a client who is self-employed. The client has expressed concerns about how high out-of-pocket expenses may come, especially if they are hospitalized. Mr. David suggests a policy with a higher premium but lower deductible, believing this will be a better option for the client. What principle of insurance is Mr. David following when making this recommendation? A. Risk avoidance. B. Risk reduction. C. Risk transfer. D. Risk retention. Answer. B. Risk reduction. Explanation. Mr. David's recommendation aligns with the principle of risk reduction, which involves mitigating the potential impact of loss. By advising the client to opt for higher premium with lower deductible, Mr. David is helping to reduce the financial risk the client might face in the event of hospital stay. This approach lowers the amount the client would need to pay out of pocket after loss event, thereby reducing their financial exposure. Option A refers to risk avoidance, which involves eliminating risk entirely, something that is not being done in this scenario. Option C refers to risk transfer, which is the essence of insurance itself, transferring the risk of loss to an insurer in exchange for premium, but it does not apply specifically to Mr. David's recommendation regarding the deductible. Option D involves risk retention, where a person accepts the financial responsibility for the risk themselves, such as through high deductibles. This option would have been applicable if Mr. David had recommended higher deductible to lower the premium. Question 3. Which of the following is a primary duty of an insurance producer when advising a client about a life insurance policy? A. To guarantee the client will never experience any financial loss. B. To disclose any commission or financial interest the producer has in the sale. C. To recommend the most expensive policy available to maximize commissions. D. To advise clients on legal disputes unrelated to insurance. Answer. B. To disclose any commission or financial interest the producer has in the sale. Explanation. One of the primary duties of an insurance producer is to uphold transparency and ethical standards, which includes disclosing any commission or financial interest that may influence their recommendation. This ensures that the client can make an informed decision based on all relevant factors and prevents conflicts of interest. Ethical guidelines set by state insurance regulations require producers to disclose commissions so clients understand potential biases in the advice given. Option A is not a duty of an insurance producer, as it is not possible to guarantee against all financial loss in an insurance policy. Option C violates ethical standards, as producers are required to act in the client's best interest and avoid recommending unnecessarily expensive policies. Option D is outside the scope of the producer's duties, as they are primarily responsible for advising on insurance products, not providing legal counsel. Question 4. Which of the following is an example of a situation in which a policyholder could invoke the waiver of premium rider on a life insurance policy? A. The policyholder is unable to pay premiums due to financial hardship. B. The policyholder is diagnosed with a critical illness and is unable to work. C. The policyholder has decided to cancel their policy because of high premiums. D. The policyholder has exceeded the maximum age limit for the policy. Answer. B. The policyholder is diagnosed with a critical illness and is unable to work. Explanation. The waiver of premium rider is typically triggered when the policyholder becomes disabled due to illness or injury, such as being diagnosed with a critical illness. This rider allows the policyholder to stop paying premiums while maintaining coverage as long as the disability or illness persists. The rider is designed to help prevent a lapse in coverage if the policyholder is financially unable to continue paying due to illness or injury. Option A refers to financial hardship, which is not typically covered by a waiver of premium rider unless it is due to disability. Option C involves voluntary cancellation, not an event covered by a waiver of premium rider. Option D relates to the age limit, which would result in policy termination, not activation of a waiver of premium. Question 5. Which of the following is a defining characteristic of a mutual insurance company? A. The company's primary goal is to maximize shareholder profits. B. Policyholders are considered both customers and partial owners of the company. C. The company operates for the benefit of stockholders who receive dividends. D. The company is governed by a board of directors who are elected by policyholders only. Answer. B. Policyholders are considered both customers and partial owners of the company. Explanation. A mutual insurance company is owned by its policyholders, meaning the individuals who hold insurance policies with the company are both customers and owners. These policyholders have the right to vote on company matters and may receive dividends if the company performs well financially. The main goal of a mutual insurance company is to serve the interests of its policyholders rather than to generate profits for stockholders, as is the case with a stock company. Option A refers to a stock insurance company where the goal is to maximize profits for shareholders. Option C describes a stock company where profits are distributed to shareholders as dividends. Option D can apply to both mutual and stock companies, but in a mutual company, the policyholders typically elect the board of directors. Question 6. Mr. Stevens has recently been approved for a life insurance policy with a face value of $500,000. The insurance company has placed a restriction on the policy to exclude coverage for any claims resulting from self-inflicted injuries. What type of policy provision is this? A. Beneficiary clause. B. Suicide clause. C. Contestability clause. D. Exclusion clause. Answer. B. Suicide clause. Explanation. A suicide clause is a common provision in life insurance policies that limits or excludes coverage in cases where the policyholder dies by suicide within a certain period, usually 2 years after the policy's inception. The intention is to prevent individuals from purchasing insurance with the intent to commit suicide and have their beneficiaries collect death benefit. Option A refers to the beneficiary clause, which specifies who is entitled to the death benefit in the event of the policyholder's death. Option C refers to the contestability clause, which allows the insurer to investigate and potentially deny claim if the policyholder dies within the first 2 years of the policy, often for reasons other than suicide. Option D refers to an exclusion clause, which can apply to various conditions or risks, not just suicide. Question 7. Which of the following is the primary responsibility of an insurance producer in relation to a client's policy? A. To ensure the client's policy remains active, regardless of any changes to their personal situation. B. To guarantee that the policy will always provide the maximum possible benefit. C. To ensure that the policy is appropriate for the client's needs and goals. D. To manage the client's claims process and guarantee payout. Answer. C. To ensure that the policy is appropriate for the client's needs and goals. Explanation. An insurance producer's primary responsibility is to recommend policy that aligns with the client's specific needs, goals, and circumstances. This involves conducting thorough needs analysis to determine the appropriate type and amount of coverage. The producer must act in the best interest of the client, ensuring that they fully understand the policy and how it meets their needs. Option A is incorrect because the producer cannot guarantee that the policy will remain active regardless of the client's situation. The client's failure to meet premium payments or changing circumstances may affect the policy. Option B is also incorrect because no insurance policy can always guarantee the maximum benefit. There are limits, conditions, and exclusions within every policy. Option D refers to claims management, which is typically the responsibility of the insurer, not the producer. Question 8. Which of the following is an example of a risk retention group? A. A large corporation purchasing liability insurance for its employees. B. A group of small business owners coming together to pool resources and cover certain types of risk collectively. C. An individual purchasing a personal auto insurance policy. D. A government entity offering insurance coverage to its employees. Answer. B. A group of small business owners coming together to pool resources and cover certain types of risk collectively. Explanation. A risk retention group or a G is a group formed by multiple businesses or organizations to collectively assume and manage certain types of risk, such as liability. The group operates as an insurance provider for its members, pooling resources to cover potential claims. This structure is often used by businesses in the same industry that share similar risks. Option A is an example of a traditional insurance policy purchased by a single entity, not a risk retention group. Option C refers to an individual purchasing personal insurance, not the pooling of risk within a group. Option D refers to government-provided insurance, which is a different structure from a risk retention group. Question 9. Which of the following best describes the term underwriting in the context of insurance? A. The process of investigating claims to determine the amount of loss. B. The process of setting premiums based on risk evaluation. C. The process of selling insurance policies to potential clients. D. The process of making a decision about whether to pay out a claim. Answer: B. The process of setting premiums based on risk evaluation. Explanation: underwriting refers to the process through which an insurance company evaluates the risk associated with an applicant or a policyholder. This process involves reviewing the applicant's personal details, health history, lifestyle, and other risk factors to determine the appropriate premium to charge. The goal is to assess whether the applicant should be insured and at what cost, ensuring that the insurer can remain profitable while providing coverage. Option A refers to claims investigation, which is done after a claim is filed to assess the loss. Option C refers to the role of sales agents or producers, not the underwriting process. Option D refers to the claims adjudication process, which involves determining whether the claim is payable, not the evaluation of risk before issuing policy. Question 10. Which of the following types of insurance is typically considered a non-participating policy? A. Whole life insurance. B. Universal life insurance. C. Term life insurance. D. Variable life insurance. Answer: C. Term life insurance. Explanation: a non-participating policy is one in which policyholders do not share in the insurer's profits through dividends. Term life insurance is typically non-participating because it provides coverage for a specific period and does not accumulate any cash value or provide dividends. Option A refers to whole life insurance, which is usually a participating policy allowing policyholders to receive dividends. Option B refers to universal life insurance, which can also be participating or non-participating depending on the insurer. Option D refers to variable life insurance, which is generally a participating policy as it allows the policyholder to invest in various options and potentially receive dividends. Question 11. In which of the following situations would a moral hazard most likely occur? A. A policyholder consistently overestimates the value of their property. B. A policyholder has an incentive to take on more risk because they are insured. C. A policyholder fails to disclose certain risks during the underwriting process. D. A policyholder buys more insurance than they need, thinking it will provide full coverage. Answer: B. A policyholder has an incentive to take on more risk because they are insured. Explanation: moral hazard refers to the situation where an individual or organization may take on more risk because they are protected from the consequences by insurance. This can occur because the insured knows that the insurance company will bear the financial burden of a loss, making the individual less cautious. Option A refers to an adverse selection problem where a policyholder overestimates value, not moral hazard. Option C also refers to adverse selection where risks are hidden from the insurer. Option D reflects the overinsurance issue, not moral hazard. Question 12. Which of the following would be considered an example of a fiduciary responsibility for an insurance agent? A. Making a profit on the sale of insurance policies. B. Ensuring the client fully understands the terms of the policy. C. Offering the lowest premium available to the client. D. Choosing policies based solely on commissions. Answer: B. Ensuring the client fully understands the terms of the policy. Explanation: a fiduciary responsibility involves acting in the best interest of the client. Insurance agents have an ethical duty to ensure their clients fully understand the policies they are purchasing, including the terms, conditions, and exclusions. Option A and D focus on the agent's self-interest, which violates fiduciary duties. Option C is a price-related issue, but it does not necessarily reflect a fiduciary responsibility to ensure the best interests of the client. Question 13. Which of the following is typically covered under a comprehensive automobile insurance policy? A. Theft of the vehicle B. Damage caused by the vehicle's driver to other vehicles. C. Medical expenses for the vehicle's driver and passengers. D. All of the above. Answer: D. All of the above. Explanation: a comprehensive automobile insurance policy covers a broad range of incidents including theft, damage caused by the driver to other vehicles, and medical expenses for the driver and passengers. It offers extensive protection beyond just collision-related damages. Option A, B, and C are all part of comprehensive coverage in most policies. Question 14. Which of the following is not an example of a hazard in the context of insurance? A. A slippery road that increases the likelihood of a car accident. B. A fire safety system in a building that reduces the likelihood of fire damage. C. A policyholder who engages in reckless behavior while driving. D. A health condition that predisposes someone to a specific illness. Answer: B. A fire safety system in a building that reduces the likelihood of fire damage. Explanation: a hazard is a condition or situation that increases the likelihood of a loss occurring. A fire safety system is a preventive measure that reduces the risk of a loss, not a hazard. Hazards could be physical, like slippery roads, moral, like reckless driving, or legal, like certain health conditions. Options A, C, and D all involve hazardous conditions that increase the likelihood of a loss. Question 15. What is the primary purpose of a coinsurance clause in a property insurance policy? A. To ensure the policyholder pays the full premium amount. B. To encourage policyholders to purchase adequate coverage. C. To reduce the insurer's liability for claims. D. To limit the amount the insurer will pay on claim. Answer: B. To encourage policyholders to purchase adequate coverage. Explanation: a coinsurance clause is included in property insurance policies to encourage the policyholder to insure their property for a percentage of its value, typically 80%, 90%, or 100%. If the property is underinsured, the clause reduces the insurer's payout in the event of a loss based on the amount of coverage purchased relative to the property's value. Option A refers to premium payments, not the purpose of coinsurance. Option C is misleading, as coinsurance encourages adequate coverage, which reduces the likelihood of an insurer having to pay less in claims. Option D describes the impact of coinsurance, but the purpose is to encourage the right coverage rather than simply limit the insurer's payout. Question 16. Which of the following is a key difference between unilateral contracts and bilateral contracts in insurance? A. Unilateral contracts involve mutual promises, while bilateral contracts do not. B. Unilateral contracts involve only one party making a promise, while bilateral contracts involve promises from both parties. C. Bilateral contracts require a payment of premiums, whereas unilateral contracts do not. D. Bilateral contracts are unenforceable in insurance, but unilateral contracts are valid. Answer: B. Unilateral contracts involve only one party making a promise, while bilateral contracts involve promises from both parties. Explanation: in a unilateral contract, only one party makes a promise. In insurance, the insurer promises to pay for covered losses if the policyholder pays premiums, while the policyholder has no corresponding obligation other than to fulfill conditions of the policy. In a bilateral contract, both parties make promises to each other. Option A is incorrect because both types of contracts can involve mutual promises in different ways. Option C is not accurate, as both types of contracts involve premiums in insurance policies. Option D is incorrect, as both types of contracts can be enforceable in insurance depending on the specifics of the agreement. Question 17. Which of the following is a key feature of a health maintenance organization HMO insurance plan? A. It covers out-of-network care without requiring referrals. B. It provides broad access to a variety of healthcare providers. C. It requires policyholders to select a primary care physician PCP. D. It does not cover preventive care services. Answer: C. It requires policyholders to select a primary care physician PCP. Explanation: a health maintenance organization HMO insurance plan requires policyholders to choose a primary care physician PCP who manages their care and provides referrals to specialists. HMO plans typically have lower premiums and out-of-pocket costs, but have more limited networks and require PCP referrals for specialized care. Option A is incorrect because HMOs typically require policyholders to use in-network providers and obtain referrals for out-of-network care. Option B is incorrect. HMO plans generally limit the access to healthcare providers within a specific network. Option D is incorrect because HMOs often cover preventive care services as part of their focus on cost-effective healthcare. Question 18. Which of the following best describes the function of a reinsurance company? A. It helps insurers pay claims by taking on some of the financial risk. B. It provides insurance directly to consumers for various risks. C. It helps policyholders invest their premiums for future returns. D. It determines the premiums for health and life insurance policies. Answer A. It helps insurers pay claims by taking on some of the financial risk. Explanation. A reinsurance company provides insurance to primary insurers, allowing them to transfer a portion of their risk. This helps insurers reduce their exposure to large claims, stabilize their financial position, and remain solvent. Option B refers to primary insurance companies, not reinsurance companies. Option C refers to the role of investment firms, not reinsurance. Option D refers to the underwriting process, not reinsurance. Question 19. Which of the following is an example of an absolute liability situation in insurance? A. A driver causing an accident due to distracted driving. B. A company's workers being injured due to unsafe working conditions. C. Person's property being damaged during natural disaster. D. Manufacturer being held liable for defects in product regardless of fault. Answer D. A manufacturer being held liable for defects in a product regardless of fault. Explanation. Absolute liability refers to situations where a party is held liable for damages or injuries even if they were not at fault. This is typically the case with activities or products deemed inherently dangerous, such as product liability. Option A is an example of negligence where the driver is at fault. Option B refers to workers' compensation but does not necessarily involve absolute liability. Option C refers to a force majeure situation, not absolute liability. Question 20. Which of the following is true regarding a whole life insurance policy? A. It only provides coverage for a specified term, typically 1030 years. B. It provides a death benefit and also builds a cash value over time. C. It is a form of term insurance that can be renewed without proof of insurability. D. It does not require regular premium payments after the initial premium. Answer B. It provides a death benefit and also builds a cash value over time. Explanation. A whole life insurance policy is a type of permanent life insurance that provides both a death benefit and a cash value component which grows over time. The policyholder can borrow against this cash value or use it to pay premiums. Option A refers to term life insurance, not whole life. Option C describes features of renewable term life insurance, not whole life. Option D is incorrect because whole life policies typically require regular premium payments to maintain coverage. Question 21. In which of the following situations would subrogation most likely occur? A. An insurance company pays a claim and then seeks reimbursement from the at-fault party's insurer. B. An insurer allows policyholder to reduce their coverage limits after loss. C. Policyholder makes false statement about the cause of claim. D. An insurance policyholder cancels their policy before the renewal period. Answer A. An insurance company pays a claim and then seeks reimbursement from the at-fault party's insurer. Explanation. Subrogation occurs when an insurance company seeks to recover the amount it paid on claim from the party responsible for the loss or their insurance company. This process helps the insurer mitigate their financial losses. Option B refers to policyholder changing their coverage limits, not subrogation. Option C involves fraud, not subrogation. Option D describes policy cancellation, not subrogation. Question 22. Which of the following is true regarding deductibles in insurance policies? A. Deductibles reduce the insurer's risk exposure by requiring policyholders to bear a portion of the loss. B. Deductible is the maximum amount an insurance policy will pay for claim. C. Higher deductible always results in higher premium. D. Deductibles apply only to health insurance policies, not property insurance. Answer A. Deductibles reduce the insurer's risk exposure by requiring policyholders to bear a portion of the loss. Explanation. Deductible is the amount the policyholder must pay out of pocket before the insurer begins to cover claim. By requiring deductible, the insurer reduces its exposure to smaller claims as the policyholder bears some of the costs. Option B describes the policy limit, not deductible. Option C is incorrect because higher deductible typically results in lower premium. Option D is incorrect as deductibles can apply to many types of insurance, including both health and property insurance. Question 23. Which of the following would not be covered under a standard homeowner's insurance policy? A. Fire damage to the home. B. Theft of personal property from the home. C. Damage caused by an earthquake. D. Liability for injuries that occur on the property. Answer: C. Damage caused by an earthquake. Explanation: a standard homeowner's insurance policy typically covers damage caused by fire, theft, and liability for injuries on the property. However, earthquake damage is usually excluded and requires a separate policy or endorsement for coverage. Option A is typically covered under homeowner's insurance. Option B is covered as part of personal property protection in homeowner's insurance. Option D is part of liability coverage in homeowners' policies. Question 24. Which of the following types of insurance is designed to protect against business interruption? A. General liability insurance. B. Workers' compensation insurance. C. Business income insurance. D. Life insurance. Answer: C. Business income insurance. Explanation: business income insurance, also known as business interruption insurance, is designed to protect businesses from income losses when they are unable to operate due to a covered event, such as a fire or natural disaster. This insurance covers lost revenue and ongoing expenses during the interruption. Option A covers liability for third-party injuries or damages, not business interruptions. Option B covers worker injuries, not income losses. Option D provides coverage for death benefits, not business income loss. Question 25. What does the term insurable interest mean in the context of life insurance? A. The beneficiary's financial stake in the insured's life. B. The insurer's profit from issuing life insurance policy. C. The policyholder's right to change the beneficiary. D. The policyholder's financial stake in the life of the insured. Answer: D. The policyholder's financial stake in the life of the insured. Explanation: insurable interest refers to the financial interest that policyholder must have in the life or property they are insuring. In life insurance, the policyholder must demonstrate financial stake in the life of the insured to ensure the policy is valid. Option A refers to the beneficiary's interest, not the policyholder's. Option B is unrelated to the concept of insurable interest. Option C involves the policyholder's rights but does not define insurable interest. Question 26. Which of the following would most likely be considered an exclusion in a life insurance policy? A. Death by natural causes. B. Death from a motor vehicle accident. C. Suicide within the first 2 years of coverage. D. Death from an illness diagnosed after policy issuance. Answer: C. Suicide within the first 2 years of coverage. Explanation: most life insurance policies contain an exclusion for death due to suicide within the first 2 years of coverage. This period is known as the suicide clause. If the insured dies by suicide during this period, the insurer may deny the death benefit. Option A and B would generally be covered unless specified otherwise in the policy. Option D refers to coverage for illness, which generally would be included if the illness is diagnosed after policy issuance. Question 27. Which of the following describes the primary purpose of liability insurance? A. To provide financial support for a policyholder's family after their death. B. To cover damages caused to third parties for which the policyholder is responsible. C. To cover medical expenses resulting from an accident. D. To pay for damages to the policyholder's own property. Answer: B. To cover damages caused to third parties for which the policyholder is responsible. Explanation: liability insurance is designed to protect the policyholder from financial losses due to damages or injuries they cause to others. This includes coverage for legal defense costs, property damage, and bodily injury for which the insured is responsible. Option A refers to life insurance, not liability insurance. Option C refers to health insurance or accident insurance, not liability insurance. Option D refers to property insurance, not liability insurance. Question 28. Which of the following is not a common feature of flood insurance policies? A. Coverage for water damage from heavy rains or overflowing rivers. B. Coverage for damage from sewer backups or some pump failures. C. Coverage for damage from wind-driven rain. D. Coverage for damage to personal property located in a flood zone. Answer: C. Coverage for damage from wind-driven rain. Explanation: flood insurance generally covers damage caused by flooding, such as heavy rain, river overflow, or coastal storm surges. It does not typically cover damage from wind-driven rain, which is usually covered by standard homeowners insurance policies. Option A is correct if flood insurance covers damage from heavy rains and floods. Option B is correct as some flood policies cover damage from sewer backups or some pump failures. Option D is correct if flood insurance can cover damage to personal property in a flood zone. Question 29. Which of the following types of insurance provides coverage for the cost of repairing or replacing an insured's vehicle after an accident? A. Liability insurance. B. Collision insurance. C. Comprehensive insurance. D. Uninsured motorist insurance. Answer. B. Collision insurance. Explanation. Collision insurance provides coverage for damage to the policyholder's own vehicle resulting from an accident, regardless of who was at fault. It helps pay for repairs or replacement of the vehicle. Option A provides coverage for damages the insured causes to others, not their own vehicle. Option C covers non-collision related events like theft or vandalism. Option D covers damages caused by an uninsured driver, not collision damages. Question 30. In a claims-made liability insurance policy, when is coverage provided? A. Only if the claim is made and reported during the policy period. B. Only if the event that caused the claim occurred during the policy period. C. Only if the policyholder is sued for damages during the policy period. D. Coverage is retroactive to the inception date of the policy. Answer A. Only if the claim is made and reported during the policy period. Explanation. A claims-made policy provides coverage for claims that are made and reported to the insurer during the policy period, regardless of when the event leading to the claim occurred. This is different from an occurrence policy, which provides coverage for events that happen during the policy period, regardless of when the claim is filed. Option B describes the features of an occurrence policy, not a claims-made policy. Option C is incorrect because the claim must be made, not just the suit. Option D is incorrect. Claims-made policies do not automatically offer retroactive coverage.